Here in part 7 of our chapter 3 video lecture, the next topic is interest income. Right now with the COVID-19 situation, the federal government is artificially pushing down interest rates. So for most people, they will have very little, if any, interest income to report for this and then possibly the next few years. But any interest income you earn has to be reported and you pay taxes on it. So most financial institutions will report interest income on this form called a 1099 INT. And let's see, it's coming from this payer here to our taxpayer over here. And the main box is this box number 1, showing the interest income earned from the year. The payer is not required to issue out this 1099 form if the interest income paid out during the year to this taxpayer is less than $10. But that doesn't make it tax-free. You still gotta report the interest income. Interest income that is based upon U.S. savings bonds and Treasury bills, notes, and bonds are separately stated here in box 3. It's still taxable on your 1040 form, but it should be tax-free on any state income tax return. And even if the interest is tax-free, here called tax-exempt interest, sometimes we call this type of interest municipal interest or municipal bond interest. If you buy a bond from a state government or city or county governments, generally, not always, but generally, that interest is tax-free, but it still has to be reported to the taxpayer here on a 1099 form. So here is some summaries about interest income in our textbook. Again, municipal interest, tax-free, tax-exempt interest, you still have to report it, but you don't pay any taxes on that type of interest. The most common type of interest, if you do receive any, is based upon a bank or savings and loan or credit union, checking or savings account. Also, we have what we call certificates of deposit, where you wait so many months or years, then you can collect your interest. If the interest is going to be earned over a period less than a year, you don't have to report it until you collect it. If the interest is earned over multiple years, then you probably have to report it at the end of each year. Remember that accrue basis we talked about? Yeah, you cannot wait to the time you collect it if it's going to take more than 2 tax years. Savings bond interest. The nice thing about savings bond interest, when you buy the savings bond, each year it's going to grow in value, and you don't have to report the interest under that accrue basis as it gets bigger and bigger, the value of the bond. You can wait until you cash in the bond and then report all the interest at that time. I believe bonds usually have a life of 20 or the older bonds 30 years. That's the so-called EE bonds. Yeah, and then maybe, and again, because it's federal bond interest, you don't pay any state income taxes on that interest. Now, on an option about reporting savings bond interest, instead of waiting until the bond matures, where you cash it in and report all the interest at one time, what you could do is report the amount of interest being earned each year, even though you haven't collected anything yet. So the typical situation you would want to maybe apply that type of accrue basis accounting is when the owner of the bond is a young child where they don't have any income. So if you remember back, I guess it was chapter 1, everybody had a minimum standard deduction of $1,100. Well, you can start using that and earning tax-free income by reporting your bond interest early for these young kids. Of course, if you adopt this accrue method for savings bonds, you have to apply it to all the bonds that person owns during their lifetime. In other words, you have to use the accrue method for savings bonds for any new bonds they have. Our textbook talks about using savings bonds to pay for qualifying education costs, and possibly that can be tax-free also. Again, any type of interest on federal U.S. obligations should be tax-free on the state tax return, still taxable for federal purposes. Here is a type of bond where when you buy a bond, you don't buy it at a regular, what we call face value. You buy it at a so-called discounted amount. So maybe right on the bond it says $1,000, but you're going to buy it, let's say, for $700. And over time, the value of the bond will increase all the way up to the 1,000 face value when it matures and you cash it in at that time, earning the difference of 300. That 300 is interest income. Again, this is what it means by discount. They reduce that face value down to the amount you pay for buying the bond. And then you wait and you wait and you wait, so the value of the bond will increase all the way up to the face value. And again, the difference of 300 is the interest you're going to report and pay taxes on. The issue about discounted bonds is that this $300 has to be reported over the lifetime of the bond. And you don't wait until you cash in the bond when it reaches its maturity value. If you remember, we looked at this 1099 INT form. Well, there's also a 1099 original issue discount version of this form. And it's going to be issued by the financial institution. Here it says corporation, whoever sold the bond to our taxpayer. And they're going to tell the taxpayer how much interest they're earning each year. Again, you cannot wait, until the bond matures. You got to report the interest under that accrue basis while it's being earned over the years. Okay, a lot of discussion about this type of situation that's not too common. So if that discounted bond is bought, but not from that company, not from the corporation that originally issued it, and you buy it for less than that face value, again at a discount. Let's say again you buy it at maybe $800 and you're getting interest periodically, just like a bank account. But then the face value of the bond is 1,000. So when the bond matures, not only have you received interest income, typically every 6 months, but also you're going to get back an additional $200 over the cost you had paid for the bond. This $200 is more interest. It's additional interest you got to report, not at the time you cash your bond here for 1,000, but over the years the bond is maturing. Okay, so this has to be what we call amortized over the life as additional income. Again, you're buying it at a low cost, discounted price here, and eventually you're going to get it back at a higher price, redeem it at more. That difference is more interest income you got to report over the lifetime of the bond. And there's probably not going to be maybe any 1099 form, but the taxpayer has to calculate it him or herself. Now, the opposite situation may be true, where you buy the bond for more than the face value, here called a premium. Maybe you paid $1,100 for the bond, and you're getting interest income every 6 months from whoever issued the bond. But then, when the bond matures, you're not going to get back your cost of $1,100. You're going to get back only the face value, the 1,000 amount printed on the bond. So the difference here is kind of what you lose over the lifetime of the bond. So you can reduce the interest income for the period you hold the bond by $100. And again, you spread it across the lifetime you own the bond. Again, we use the word amortize. Now, if you take a financial accounting class, like here at Kapiolani or in our UH system, Accounting 201, you probably have a whole chapter about issuing bonds from the viewpoint of the issuing corporation. But here in our tax class, we're taking the opposite point of view, the person that's buying the bond. Now, all of these situations I just mentioned is not common. Typically, it's for investors who buy stocks and bonds in the open market and they don't pay the face value price. Yeah, they're paying something more or something less, and now they got to use that premium or discount to adjust the interest income that they're reporting each year. If you make a loan or receive a loan and it's not charging the market rate interest, the government says you gotta force it to be a market rate interest, here called imputed interest. It may be common between related parties to shift income from a high tax taxpayer to a lower taxpayer to save taxes overall. So the rest of this section regarding interest income kind of talks about that. For example, loans between parents and children. And if the loan is not charging a fair rate, possibly you can treat that as what they call a gift. And you may need to adjust the interest rate so it's a fair rate. So you don't try to artificially shift income to a low taxpayer, typically to a child. Same thing is true when you have lending between a corporation and shareholder. One situation is the shareholder would invest money in the corporation they own. That's called a stock or capital contribution. And when the corporation pays a dividend, which is the next topic here in Chapter 3, the shareholder has to report that as income. But the corporation cannot deduct that dividend. But how about instead the shareholder lends money to the corporation and now it pays interest to that shareholder? Well, this interest is taxable to the shareholder but now deductible by the corporation. So you have to be careful whenever there are situations of money being borrowed and lent between related parties, making sure they charge a fair rate, yeah? And the federal rate is this amount, and the fair rate would be based upon that federal rate. So let's skip all of this detail here. Okay, I'm not going to hold you responsible for that type of interest income being so-called imputed. Let's take a look at how about again the 1099 form, and again this is the key box here, box number 1. And if the total interest income that you have to report is more than $1,500, you first have to report the interest income here. Interest income here reported in part 1. Dividend income, we'll talk about this in the next videos, reported in part 2. You would list out the name of the paying institution and then the dollar amount, the next institution and then the dollar amount. Again, you do this if the total down here is more than $1,500. If not, whatever your total is, it goes straight to the 1040 form. The next section talks about using the proceeds of that savings bond, yeah? Either the EE or the I ones. And if you use the proceeds for qualifying education expense, you can subtract out any of that type of interest you're reporting up here, reducing the amount. In my 30 to 40 years worth of tax experience, I've never seen this being used. There's better ways to save for tax purposes when you save for fund for education. Okay, so this box, and whenever again it's more than 1500, you gotta fill out this part 1. And then at the bottom of the form, here after the dividend section is a part 3, where you need to disclose whether any of your investment accounts, foreign accounts, well, if they are foreign, yeah, foreign type, be it that you have owned the account, yeah, own the account, or if you're controlling or beneficiary of a trust, foreign trust. This doesn't increase automatically your tax, it's just a disclosure. You may need to, if you meet the conditions, to fill out this F-bar, what they call F-bar reporting form. Again, this is not a tax return, it's just disclosing. Okay, so the total interest, be it reported here on Schedule B, or if it's less than 1500, then goes back to the 1040 form in line 2 over here. where you would add it up with your other income to get the total income. Now off to the side here in 2A would be the tax-free municipal bond interest we had just talked about also, yeah. But notice it's not included in the left-hand column to be added up and taxed on. If you remember in the previous video, in the calculation to determine how much Social Security benefits are taxable, again, here's the gross amount of Social Security benefits received, and we went through that complex, detailed calculation to figure out how much was taxable. Included in that calculation was the tax-free interest. So again, the tax-free interest, you don't pay taxes on it, but it may come into play in calculating how much Social Security benefits are taxable. That Schedule B, if you did fill one out, has to be attached to our 1040 form. Okay, take a look at the next video where we talk about this line 3A for dividend income.